Strength, right?
Bonds in the markets, it would seem. Joining us now is Komal Sri-Kumar, president of Sri-Kumar Global Strategies. And Sri, we're obviously sort of unwinding a little bit of the moves that occurred at the very end of last year, both in equities and in fixed income. Bond market got pretty confident in a hurry that disinflation certainly has some momentum to it, and the Fed's going to be cutting significantly. Where do you think that leaves, let's say, the 10-year around 4%? Corporate credit spread's really tight. It seems like everyone was pretty happy with the soft landing scenario. Where do you come down?
I think a good part of what has happened, Dom, is a result of the uncertainty, the volatility that was caused by contradictory messages from the Fed. Actually, if you were to look at the bond yields by themselves and you did not concern yourself about the Fed messages, then you should have had a much more stable 10-year Treasury yield. Instead, what you had was a December 13th press conference by the Fed chairman, who essentially gave the tailwind even more of a propeller up, and then it pushed up, and then you had John Williams of the New York Fed pulling you down. We have had different Fed people, including Raphael Bostic, talking in terms of how it is too soon to expect a rate cut. All of those were ready to cause the treasuries to, again, the yield to move up again. Has anything really seriously happened to cause all of this move, Mike? I don't believe so. So I really think that around the 4%, 410, 415 mark, the U.S. Treasuries at 10-year is a buy. You're going to be very happy a year to 2 years from now.
I mean, on some level, Sri, it's markets doing what markets do around an inflection point in policy, and the committee is not necessarily all in unison about their particular outlooks. I mean, I don't know. It doesn't seem to me that the market has been really unusually volatile around this. However, if you think 4%-ish on the 10-year is a buy, what are your assumptions that feed into that view? In other words, do you think that we have a rapidly decelerating economy? Is it just about inflation being friendly and we have, real yields are now attractive again?
That's a great set of questions, Mike. My assumption here is, with the interest rates having risen so sharply during 2022, 2023, and now being reduced, or at least kept paused right now with the possibility of a decline, you still have something that is going to break in the system, whether it comes from banks which are losing deposits, if you look at the small and medium-sized banks, or if you were to look at the commercial real estate problem, the credit crunch. Any one of those could cause another big failure, and that is what is going to cause the Fed to ease, not lower inflation rate, and that in turn is going to cause the long-dated yields to also come down. So it is a result of a breakage in the system rather than a result of the inflation coming down.
Sri, didn't something break about 10 months ago? We had banks go bust. A lot of people thought at the time Fed's got to be done. In fact, it should be cutting soon. It didn't happen. We kind of absorbed it. And I guess before that, you could argue we lost trillions in crypto value. We saw the speculative parts of the stock market implode. I guess what particularly makes you think we have further vulnerabilities systemically?
Something did happen last March. Between March 1st and March 15th of 2023, you had quantitative tightening shifting to quantitative easing. The assets of the central bank went back to the November 2022 level because the Fed hastily gave up on its tightening program. And then they started to go back again to quantitative tightening. But that you're talking about relatively small banks in the setup. If you have medium-sized bank failure, or if you have a big failure on the commercial real estate side that makes big news, then you're going to have a more long-lasting easing of policy. And that is the difference between March of last year and what I look for the next 3 to 6 months.
Sri, we have about a minute, so I want you to walk me through all of 2024 in that 60 seconds here. Tell me when the Fed cuts, how much it cuts, and I think the most important question that Wall Street's really focused on right now is when or if the curve disinverts.
A terrific question, Steve. Let me give you a timeline. Obviously, they are subject to change, but within the 1 minute that you gave me, I'm expecting within the next 3 to 4 months something breaks. Let's assume it breaks by March, April. Then the first rate cut also happens in March, April. Quantitative tightening is stopped, and then you have quantitative easing following, and then that is the whole thing progresses further. The 2 to 10 year, which is now about minus 38, minus 40 basis points, goes to zero very quickly within 3 months, and then the yield difference becomes positive for the rest of the year.